Jamie Dimon published his annual shareholder letter on Monday, and the first thing he warned about was not a bank failure or a credit crisis. It was arithmetic. The U.S. has been at war with Iran for less than 2 months, and Dimon is already telling markets they are mispricing what comes next. The mechanism is not complicated, but it is underappreciated. Iran still controls the geography of the Strait of Hormuz, and as long as that strait remains contested, roughly 20% of the world's seaborne oil passes through a choke point under active military pressure. Qatar has frozen LNG exports after 2 tankers turned back at Hormuz. The UAE's largest natural gas processing facility halted production following Iranian drone strikes. Kuwait's refining infrastructure took hits over the weekend. These are not warnings. These are events that already happened. Dimon's arithmetic follows directly. Sustained oil disruption does not stop at the gas pump. Fertilizer, helium, plastics, and shipping all run on oil derivatives. That means food prices, construction costs, and freight rates all carry the war premium. Goldman Sachs has revised its December 2026 PCE inflation forecast up to 3.1% and puts a 30% probability on recession under a prolonged conflict scenario. Larry Fink at BlackRock has said oil at $150 would trigger a stark and steep recession. Brent crude is already tracking toward Goldman's revised $98 forecast, up roughly 40% from last year's average.
The part that matters most for markets is what Dimon says comes after inflation. Interest rates are, in his words, like gravity to almost all asset prices. If inflation stays above the Fed's 2% target and the war premium keeps feeding it, the Fed faces a choice between hiking into a slowdown or holding while prices accelerate. Morgan Stanley flagged a compounding risk that makes this worse. Wartime defense spending is piling on to an already elevated U.S. debt load, which pushes long-term Treasury yields higher regardless of what the Fed decides. The 10-year break-even inflation rate rose to a 2-week high of 2.38% on Monday. The market is starting to price in what Dimon has been saying. The same week that oil markets are repricing war risk, Tesla delivered 358,000 vehicles in the first quarter of 2026, missing Wall Street's estimate of 372,000 by roughly 4%. That would be unremarkable if it were a one-time miss. It is not. Tesla missed delivery estimates in the prior quarter as well, and full-year 2025 deliveries declined 9% year-over-year. JPMorgan has issued a formal warning of a potential 60% decline in Tesla's stock price from current levels. The causal chain JPMorgan is following runs through free cash flow. Tesla's full-year 2025 net income fell 46.79% year-over-year to $3.79 billion, and operating income dropped 38.45% to $4.36 billion. Operating expenses surged 39% in the fourth quarter, driven by AI and robotaxi R&D. Tesla is spending heavily to build its next revenue layer, Cybercab, robotaxi expansion, Tesla Semi, while the existing revenue layer, which is selling cars, is contracting. That combination pressures free cash flow even before accounting for the fact that U.S. federal EV tax credits no longer exist, adding real demand headwinds that engineering cannot fix.
The valuation is where this becomes structural. Tesla's trailing PE ratio sits at 334 times earnings. Its forward PE is 172 times. Those multiples are defensible only if the bull case, AI, robotaxi, autonomous driving revenue, materializes on schedule. JPMorgan's call is not that Tesla fails, it is that a valuation of 334 times earnings embedded in a company with 2 consecutive delivery misses and a 47% net income drop leaves almost no margin for error. Wedbush's Dan Ives maintained his $600 price target, pointing to AI and robotaxi potential. The disagreement between JPMorgan and Wedbush is precisely this. Is Tesla being priced on what it earns today or what it might earn in 5 years? The delivery data is making that question more expensive to get wrong. Here is the tension that Monday's market does not fully resolve. Stocks closed higher. The S&P 500 rose modestly, the Nasdaq 100 climbed 0.4%, and Bitcoin surged 4%, all driven by Axios reporting that the U.S., Iran, and regional mediators are discussing a potential 45-day ceasefire. Dip buyers returned. The market treated the ceasefire report as a reason to buy. On the same day, the ISM Services Prices Paid subindex rose to 70.7, a 3.5-year high, against an expectation of 67.0. That is the inflation signal embedded in the sector that employs the most Americans. It printed at a multi-year high on the same day that investors were buying the ceasefire dip. The two signals are not compatible if the ceasefire does not materialize. Iran's foreign ministry said Monday that no rational person would accept the ceasefire proposal. President Trump extended his Hormuz reopening deadline by 20 hours to Tuesday evening and threatened to unleash all hell if the strait is not reopened. The International Energy Agency warned that even if the war ended within weeks, damaged energy infrastructure means normal Hormuz flows would take additional time to restore. The weight of evidence points toward the ceasefire optimism being premature. The ISM prices paid data at 70.7 does not reflect a war premium that is about to disappear. It reflects cost pressure that has already been transmitted into the services economy. If the Tuesday deadline passes without a deal and the Diamond-Goldman-Fink inflation scenario continues to build, the rate gravity that Diamond described will become the dominant force in markets over the next several weeks. The verification benchmark is concrete. Watch whether Iran reopens Hormuz by Tuesday evening, and watch the 10-year Treasury yield the following morning. A yield move above 4.4% on ceasefire failure would signal that the bond market is beginning to price the rate hike scenario that equities have not yet absorbed. The one scenario that would prove this wrong is a genuine ceasefire signed before Tuesday's deadline, in which case oil drops, break-even inflation falls, and the dip buyers who came back on Monday would have been early and right.